the right thing to understand is what is the profit of Ethereum relative to the profit of Amazon. And the one thing I pointed out is that Amazon literally made no profit until basically about 20 years in as a business.
What's up, everybody? It's LG Doucette here, and welcome to the Milk Road Show, the daily crypto show that stays on the sidelines of the major bottles, but hands out the popcorn when things get real spicy. Today is December 9th, 2025. We're recording this late on December 8th, and Haseeb is here. He was one of the main contestants in the big battle on crypto Twitter that's been raging for the last 10 days about L1s and their value. He's also the managing partner at Dragonfly, and we're going to dig into what he's seeing in the industry, what they are seeing in the industry, and really, honestly, what we all want to talk about is what is the long-term value of our top favorite chains and all the other chains that are still launching after them. So we have a lot to dig into. Haseeb puts out tons of content, so we're going to try and zip through this one as quickly as we can. Before we start, shout out to our sponsors. Reserve DTFs get exposure to the entire crypto market in a single token. Chainlink, break the interoperability barrier and power the future of tokenized finance. And Bridge, power your business with instant stablecoin payments. No friction, no banks, just global finance made simple. Haseeb, dude, welcome back to the show, man. It's good to have you at this point in time, especially.
Happy to be here again, man.
Okay, so we need to recap because not everybody, shockingly, it may surprise many people, but we don't all spend all our time on crypto Twitter. Some people like to listen to podcasts when they're driving in the car and not read all the tweets. Can you please recap for us, and don't spare details, what the hell happened last week between you and Santiago that merited a full-on brawl on the Thread Guy show? What started this, and what was it all about?
Okay, so a couple weeks ago, I wrote a post called In Defense of Exponentials. And this is a post basically describing the spiritual capitulation that I've been seeing from a lot of people about whether or not layer ones are overvalued, whether they're ever going to be able to capture value. And this idea that, hey, this is an exponential technology. This technology has been getting bigger and bigger over time. It's gobbling up the entire world of finance from where it started, these very, very small, humble beginnings. It's more or less been this unabated story of growth, obviously with fits and starts along the way. But if you look at exponential technologies like e-commerce, like the internet, they all took this shape. None of them started printing a bunch of profit immediately in the first 5 or even 10 years. And so basically what I was advocating for was patience and not getting too despondent over, oh, hey, what happened over the last 3 months or 6 months. Over the span of a technology adoption, that's just not a long period of time. You have to zoom out and see the big picture. And that's largely what I was advocating for in my piece. So enter Santi. So Santi, important background. 2 things to know about Santi. One, Santi is, I think, one of the top 3 most active angel investors in crypto history. If you go to like the angel investor portfolios, he is, I think he's got the bronze medal. He is enormous. Okay. So very, very active investor in the space, invested in almost everything. Second, he is starting his own project called Inversion, which we actually led the seed round of. Okay, so that's another important thing to understand is that we are investors into Inversion. So I have a lot of respect for Santi. I've known him for a very long time. He's also been a crypto VC previously at Parify before he went solo and then eventually started building this project. And so he, his whole idea is that he's trying to bring real GDP on chain by taking over these companies and cryptoizing them basically. So taking like, a traditional fintech or going out and buying like a telco and then incorporating crypto payments and USDC transfers and all this other stuff in order to supercharge these businesses. That's the whole idea. So he's spending all day looking at traditional businesses and figuring out how to bring them on chain. And so he started writing in response to my post, which went pretty viral. He started writing like, hey, look, this is all great talk. Yeah, okay, it's nice to be bullish on Ethereum or Solana or whatever, but come on, let's be serious. Let's look at these P multiples. Let's look at these revenue numbers. These are embarrassing. These are nowhere near what you see for traditional companies. Even at this stage, Amazon, yeah, okay, maybe it wasn't profitable in any meaningful scale, but it was printing tons and tons of revenue, even if it was losing money, right? All of these early companies were making tons and tons of revenue, even if they weren't making a lot of profit. Compare that to Ethereum. Ethereum is trading at, he said something like 300 plus price to sales, which is just an insanely large number. These valuations are way ahead of their skis, and people are being innumerate. We can no longer justify this kind of, Pollyanna-ish approach to valuation. And so he posted this. It got some play. I came in the responses. I was like, no, you're not being sufficiently fair. Blockchains don't have revenue; they have profit because blockchains don't have expenses. So the comparison is not between revenue and revenue, the comparison is between profit and profit. And if you look at the profit of Ethereum, actually it's pretty comparable because Ethereum could be charging higher fees. They're choosing not to. And the reason why they're choosing not to is because they want to grow. And so we just kept going back and forth. And he was like, hey, what do you say we do a debate? I said, fuck yeah, let's go. I mean, I'll debate anyone anytime. And so we decided we were going to debate each other respectfully as friends. And we're going to find a neutral venue. So a bunch of people came out and said, hey, we'd love to host your debate. But each of them had a bag, so like, oh, Mert, what wanted to do? So maybe Andy, Andy coined the revenue meta, I think is his term. So we were like, okay, who's somebody who doesn't have a dog in the fight? Thread guy popped in and we said, great, we'll do it with Thread guy. So we did this debate, about an hour and a half debate of us going back and forth, barbing one way or another. And this debate kind of went super viral. So I think a Thread guy later showed me the numbers. It's got over 1 million views across all the different clips and the debate itself and all this stuff. I mean, it was a slow week. So we had a lot of time for people to dig into this debate. And it really got people talking about what is the right way to understand what these L1s are worth. Because historically, what have L1s traded on? How have they been valued historically? The answer is mostly either a combination of vibes/perception and or TVL. Those are kind of the only two things that most L1s trade on. There was a moment when Solana tried to say, oh, no, wait, we have our own metric that we've invented called REV, which stands for real economic value, which is kind of a measure of MEV and also fees and some other stuff. But then REV fell off a cliff after the meme coin mania in December, January kind of died down. And now REV is super low, and now Solana no longer talks about REV. So the reality is we don't really have good metrics to talk about layer ones besides TVL. TVL is kind of the first metric we ever came up with. And ironically, it seems to be the most stable and predictive of what chains manage to hold on to their valuations and which ones bleed out. So that's the backdrop. That was where this big conversation came from. Of course, I've been on the side of being bullish layer ones and believing that the future is going to be much bigger than the past, and these things are going to continue to grow, and they're priced for growth. They're not priced for how much profit are they extracting today. And if you believe the future is going to be much bigger than the past, that's rational. Whereas Santi, he's like, look, there's a lot of stuff in this world that's growing. I don't think these things should be priced on growth. They should be priced on revenue, and they don't show revenue today.
So it sounds like Santi's taking more like the opportunity cost approach, right? That he's just saying that it's like you could be waiting this game of finding out which of these L1s are going to eventually grow and become the Amazon. Can't be all of them. Or you could look at other investments, kind of like he's doing, although he does, as the third biggest investor, clearly he sprays investments all over the place. So he does take a similar approach, but maybe with a different way for crypto to try and bring actual businesses with actual revenue and bring them on chain. Is that about correct? That's kind of what he's saying.
That's correct. Although one of the lines in the debate, which I think got a lot of play, was that he said at one point, I think he said, I'd rather own Western Union than own ETH because Western Union is trading at 4 times PE. And I told him, okay, why don't you buy Western Union? He's like, I already did. I'm super long Western Union. And so that ended up getting played over and over and over again. So
wow, that's amazing.
Yeah. So he's got his money where his mouth is. Again, I think he's wrong, but in the short term, crypto is super volatile. Obviously everybody sees the crazy volatility we've seen in these asset class.
From the debate, is there anything that you added to your perspective? Because I think sometimes talking this out, especially with a worthy debater like Santiago, somebody you know, right? Maybe that changes a little bit of your perception. Maybe 10%, maybe 20% gives you a bit of a different point of view. Has anything changed for you since this blew up?
If anything, I have become more confident in my view. I think the argument of, hey, the revenue of these companies or the revenue of these protocols is very low compared to a traditional company. That is kind of a devastating argument on its face, right? If that's the only thing you know about a layer one, you're gonna be like, wow, these things sound super overvalued. And so there's always competing frames with which to look at and understand these things. But the more that I really had to wrestle with these arguments and the more that I had to do my research, so he was insisting in the debate that the right way to look at these things is price to sales. So if you look at price to sales for Ethereum, it's something like 380. If you look at Amazon, I think Amazon topped out at price to sales of 42. And this was during the dot-com bubble. And I insisted that no, this is not the right way to look at it. The right way to look at it is as like there's no sales for a blockchain, right? The sales in some sense is like the GDP of the blockchain, which we're not measuring. There's no way to directly measure that. I mean, you could if you wanted to go and say, what are all the transaction fees being paid on every single chain, on every single application? But that, I don't know. It's not easy to find that number, and it's kind of not a useful thing to worry, to spend time trying to disentangle. The right thing to understand for a chain is, because I mean, that's like kind of the equivalent of GMV, right? The right thing to understand for a chain is the profit. Because when chains charge fees, that's profit. There's no expenses for a chain. Chains don't pay expenses, right? There's no AWS hosting cost for Ethereum. So the right thing to understand is what is the profit of Ethereum relative to the profit of Amazon. And the one thing I pointed out is that Amazon literally made no profit until basically about 20 years in as a business. And in the year, I think it was, I quoted in the debate, 2013, Amazon had a PE ratio, price to earnings, which is profit. That's what we care about. That's what almost every company trades on. The PE ratio of Amazon was over 600. Whereas today, the PE ratio of Ethereum, of course, is something like 380. So the problem is that you can say both price to sales and PE of Ethereum are the same because Ethereum has no expenses. So the question is, what's the right comparison? Is it PE or is it PS? I argue that it's PE, given that it's very difficult to come up with a good analogy of what revenue would be for a layer one.
What has been the main takeaway from this argument publicly? Like, what is the sentiment? Like, after this show that you've done and it's blown up and everything, what would you say is currently the narrative, right? Like, how do people currently feel about this? Have they joined your side and become more optimistic, or are they like Santi and they're like, holy shit, Western Union, fill me up, buddy?
I don't think you've seen a lot of demand for Western Union stocks since the debate, so I'd say probably not that. Look, it's hard to put too much. I'd say the sentiment that I have seen on crypto Twitter is that most people think I got the better side of the argument. There was one post-debate poll that Thread Guy ran where I think I got something like 62% believed that I won. So not a blowout. Like, it's not that everybody thinks Santi is wrong, but I think you can also see to some degree people voting with their wallets that, it's not like these L1s just drop like a stone because people suddenly realize something they didn't know before. Which I think would be, if this was truly an emperor has no clothes moment, that, hey, turns out there are no good arguments as to why you should continue to believe in things like Ethereum and Solana, then that might have been the outcome, is that, like, wow, all of a sudden a generation of investors was just hit in the head with the realization that they were investing in a bunch of nonsense. And I don't think that's the takeaway, and I don't think that's true.
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto-native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer. Sure, tokenized financial products are the future, but there is a big sticking point. They all need to speak to each other. This is a tough problem to solve, but Chainlink does exactly that. It's the universal language for financial markets, linking Wall Street to Web3, banks to blockchain, and so much more. See how Chainlink is linking the world by going to milkroad.com/Chainlink. So it feels like your general argument, kind of having read all your posts and tuned into this debate, is that you are largely arguing against cynicism in the space, that you're like, listen, people are just too pessimistic about what's going on, right? And that they just can't see the forest from the trees in terms of, and even the Amazon analogy of just like, listen, it took 20 years for them to make money. Ethereum's already ahead of that, right? What drives that cynicism? Why? Because all these people show up every day to be here, and yet they seem to hate it. Yeah,
that's right. I mean, look, obviously there's a cognitive dissonance that people feel this year, particularly because this was supposed to be our year. We had your guys in the White House. He is passing every possible regulation to make it easy for you. All of your enemies have been defeated. The Gary Gensler is out. Everybody who is railroading you from the banking side to FinCEN to whatever, they're all kowtowing, right? All the big corporations are coming in. Stripe is launching their own blockchain. Robinhood is in the game. You've got, every major fintech company, every single bank now contemplating a stablecoin. This is supposed to be the year that you were vindicated, that everything is supposed to go up for you. And yet we got chopped. Like you said, prices are kind of up and down. Bitcoin is down on the year. We now have Bitcoin down most alts are down since the election. it sucks, right? You see your friends out there punting, AI stocks and, quantum stocks and all this other random crap, and they're all making money. Your gold bugs are making money, and yet the crypto guys have not made money this year. And that sucks. It hurts. Yeah. It feels like, why wasn't I rewarded for my faith? And I think that can result in some real acrimony towards, hey, who are the guys who kept telling me that the stuff is supposed to be valuable? Where's the value? I don't see the money going up. Now, that being said, there's obviously macro forces that superintend on everything in crypto. And there's just animal spirits, and retail is flighty and finicky, and this is a very retail-driven market. I think beyond that, like I posted something last night that also got a lot of, it was maybe night before last, that also got a lot of attention. And it was in response to a post that's gone viral recently by this guy, Ken, who posted that he realized that he'd wasted the last 8 years of his life building in crypto, and all that he sees that has come of it is a bunch of casinos. And he felt very, very disillusioned, which I think is, again, a sentiment that a lot of people felt. And I posted in response to that, they're like, look, crypto's always had casinos. There's never been a time that crypto didn't have casinos, right? So if you look at the first viral application in crypto was Satoshi Dice. The first viral smart contract on Ethereum was King of the Ether Hill, which was basically a King of the Hill Ponzi game on Ethereum. There's always been gambling. There's always been random, the first viral application on Tron was not stablecoin transfers. It was TronBet. So there have always been things like this. The industry has always had, whether it's, food coins in DeFi, or whether it's ICOs, or whether it's, meme coins or NFTs, there's always been something that represented the casino. But if you only focus on the casino, then you are missing the forest for the trees, because the big story has also been happening. It's not as volatile. It's not, people are not making their riches overnight in building stablecoins or building financial substrates or building, the DeFi rails that all this stuff is built upon. But it's all real. It's all there. It's all happening. And so the last point that I make in response to this guy, and again, I think this is very much endemic in the industry right now, is that there's always going to be people who work on the wrong things or work on things that don't have longevity. And those people are going to be disillusioned, and they're going to leave the industry. And I think that's healthy. It sucks to see, but it is healthy, because at the end of the day, I sort of analogize it to a forest, is that forests actually need to burn every once in a while to eliminate the deadwood, because that deadwood, eventually it rots and it spreads disease and it metastasizes to the floor of the forest. The forest has to burn in order to stay healthy. And it sucks to see it happen, because these are people who really invested their time and resources into the space. But either those people need to straighten out and focus on the future, or they need to leave, because there's a lot more work to do in this industry. We are nowhere near done. And the industry needs the people who are here to be fully dedicated and locked in to actually building it out.
Does the casino aspect hold it back?
I think it's kind of a false dichotomy, right? Like, you sort of can't have permissionless money without having people building casinos. In the same way, it's like, did porn hold back the internet? Like, maybe the internet would have been adopted more readily, or maybe it wouldn't have had so much puritanical pushback in the early days. Or take illegal file sharing. Did illegal file sharing hold back the internet? It's like, well, on some level, it brought a lot of people in who would never have used the internet before, but because they wanted to download MP3s. At the same time, it also created a very bad reputation for the internet. Created a lot of laws that restricted the internet that might not otherwise have been created had those things not existed. But the reality is, you cannot have an internet without file sharing, because that's what the internet does. The internet makes it instantaneous to be able to send any information. That includes information that's copyrighted. In the same way, crypto gives you the ability to do anything with money. And when you can do anything with money, you can gamble, and people will find a way. It's human nature. So I don't think it's possible to have a world of crypto without gambling, but I don't think it's really useful to look at the people who are building casinos and say, why are you doing that? You're holding us back. What's more important is for the people who are building things that are not gambling to build things better, faster, stronger, more effectively, and to get distribution for it. That's the real imperative, not to make these other people stop doing what they're doing.
When you say distribution, what do you mean? Because I think it's a common story in our industry that it's like, well, why are you guys all focused on this scammer and his repetitive scams or whatever it is, and you're not focused on this person who's the builder, who's actually built all these great applications, right? And that's normal in any industry, right? Is the kind of shitty celebrities get more attention than the actual people that are super talented. Right. How do we fix that in crypto? Is it fixable?
I mean, look, I'm not a very good social planner. I don't really have good solutions at a cultural level or at a kind of society level about how we invest more attention and goodwill into good things and less into bad things. In general, I think, like, again, the fact that, I mean, when you say that we pay a lot of attention to scammers, we pay a lot of good attention as well as a lot of bad attention to scammers, right? So the community spends a lot of time, following people who maybe don't have the best ethics or the best track records and following them into doing stuff. At the same time, they also spend a lot of time calling them out and, kind of publicly crucifying them. And that's important, actually. That is actually a very important social function, which is that there needs to be community policing, and there needs to be, because it can't be the SEC coming out and doing all this stuff. It's just not scalable enough. Like, the community has to be good at doing it itself. So on some level, I think that's okay. And actually it should be encouraged, this self-policing at an industry level. At the same time, it's not, again, the builders, it's their job. It's their job to break through the noise. It's their job to inspire people. It's their job to get other people to care and to create enough utility for them. And not everything is valuable to everyone, right? So look, if you're American and you're upper middle class, you probably don't need stablecoins. So you're fine using Visa and PayPal and Venmo and whatever. And it's like, okay, maybe I could use a stablecoin to do an international transfer, but I'm not doing that many of those. So, and obviously you'll use a stablecoin to use a crypto product, but I don't really need it to take over my financial life. So it's not that every product is supposed to be compelling to everyone. I think that's also okay.
Which builder does that best in the space then? Which builder is able to weave that line between building great products and actually advertising it a little bit? Because that's a big part of the industry, is you really have to self-advocate for the attention you want. That's a necessary part. You can't just build secretly and hope that people will care. Not all. That's right. Not almost.
Yeah, I'd say the first one that comes to mind is Hayden. The founder of Uniswap has just been an incredible advocate for not just Uniswap, but also the industry, DeFi, and just the longevity that he's had in the space as a dedicated, focused builder. And he's done so much for the industry in just terms of, they were locked in a very important battle with the SEC that they ended up prevailing in. And were it not for him standing up, I think a lot of DeFi would be in a very different position than it is today. So that's somebody who I look at. We're not investors in Uniswap, but I have an enormous amount of respect for Hayden and what he's done for the industry. There's a lot more, obviously. There's a lot of builders who've been fighting the good fight for many, many years. But Hayden is just he's almost like a Vitalik-like figure in terms of his just relentless focus and selflessness in wanting to make the space be better.
Good answer. I like that. Okay, I'm gonna circle back to something you said, because we do always want to talk about market conditions at this time, right? And circle back to you were saying about cynicism, and you said that crypto is obviously not doing well. Year to date, Bitcoin's down, and meanwhile, gold, AI, random AI stocks, those are booming. Yep. Is the depression around crypto driven by comparison right now?
I mean, if everything else was down as much as crypto, I think people would be complaining less, right? There wouldn't be as much sort of opportunity cost feeling of man, why didn't I just, YOLO into NVIDIA or something? So that being said, if you look outside of AI, I saw the stat recently that in the S&P 500, I think if you take everything outside of 41 stocks that are basically AI stocks, the S&P 500 is down since last year. So it's not just crypto that is having this kind of K-shaped experience where it's like, okay, Bitcoin's doing okay, everything else is kind of in the toilet. You see the same thing happening in the stock market. So we're in a weird economy right now. So much of the marginal demand for crypto comes from retail, and retail is hurting. Retail is kind of in the gutter right now. There's not a lot of capital to go around. And so to the extent that there is still an institutional bid in the space, that institutional bid is mostly concentrated around Bitcoin. That's why Bitcoin has been relatively resilient, whereas everything else in the space has just really gotten shafted from the election till today.
I don't think people want to compare their cryptos, have their cryptos compared to all the other stuff in the S&P. I think people want their crypto to be one of those 4 companies or 6 companies or 7 companies, the Mag 7, holding up the S&P. I think that's what we think, but clearly that hasn't been the case. What's happening with retail right now? Has retail arrived? Because that was such a big story last time, right? NFTs, they came in and then a lot of them stayed and they wanted to keep spending. But clearly now you're saying that that's the retail bid's not there. Are people poor? Are they waiting for these $2,000 Trump checks? What's going on?
So we do know that there's a lot of sign that retail is hurting.
What does that mean? What does that mean? Retail is hurting. Like, what is what?
Retail is hurting. So
that?
if you look at consumer debt defaults in the U.S., they're increasing pretty rapidly right now. You look at wage growth; it's been pretty weak. There's a lot of signs that the consumer is not doing super well. Now that being said, the U.S. is historically a very, very strong consumer-driven economy, and that means that the U.S. continues to spend and continues to accumulate debt at a time when many other countries just slow down their spending. So this is something just part of the psychology of the U.S. consumer. If you compare that to China, for example, doing very poorly. You see youth unemployment very, very high. You see the same thing in Europe. Like Europe is slowing down a lot. Youth unemployment, given that young people are a lot of the marginal buyers for crypto, is again another signal of that. I was just looking at the stat that shows that I think we're at kind of an all-time high for MBAs who are graduating and not able to find jobs. So we're starting to see the signs that like, hey, things are changing. Things are changing in the economy, and I think it's likely that the Trump administration is going to try to do something about it. You know, whether it's lowering rates more aggressively, and obviously Trump has been angling to try to get his man to get into the next seat at the Fed, as well as potentially point Fed chair come end of Q1 next year, and then beyond that, very likely they'll do some kind of fiscal stimulus before the midterms, and even the big beautiful bill. A lot of the things in there that are stimulative don't happen this year; they happen next year. So, and the Fed's still doing QT. So QT has not stopped yet. And so if Fed shifts gears or even goes into QE, you should see liquidity conditions change quite a bit. All of that stuff is part of this overall macro picture, right? The thing about AI stocks is that, AI stocks have gone up. It's kind of the only thing that's gone up, AI stocks and gold, basically. And to the extent that AI stocks have gone up, a lot of that is because, again, AI stocks are not driven by retail. They're driven by institutions. It's institutions who are kind of YOLOing into AI. But I think when retail is actually able to reload, that's when you're going to see the ability for alts to get repriced. Right now, alts are overwhelmingly retail driven. Institutions aren't buying anything except Bitcoin, maybe some ETH, but even ETH, most of the ETH ETF is held by retail, actually not held by institutions.
Say that back to me again, because you're saying that when retail reloads, they're going to go buy alts, but institutions aren't even buying alts. So is there a world where institutions come for the alts?
Not for a long time.
Why not? Why? What's holding that back?
It's just like structurally. So a few things. One, structurally, they're incapable of holding alts. There are no ETFs on alts. So there's no traditional vehicle you can use to buy some of these alts, right? DATs as well. Institutions are not buying DATs. I mean, maybe if DATs stabilize and they show that they're actually trading at 1x MNAV, but as long as DATs are flying up and down in terms of MNAV expansion and contraction, it's not what an institution wants to own. An institution wants to own a simple asset they can underwrite. And so they prefer an ETF over a DAT. Then on top of that, then there's the underwriting. So most of these institutions, this is a single name, right? If you look at something like Solana's worth 80 billion, right? That seems like, oh, wow, that's so big. Institutions must really love something that big. 80 billion, there's a lot of $80 billion companies. Most institutions are not spending their time researching a single $80 billion company. They own indices, right? They own bonds. They own like huge capital assets. They don't obsess over individual names. So that's why I say it's just not the case. And maybe Solana breaks through that barrier, but most things that are like 5 billion, 10 billion, it's like, no institution is underwriting a single 5 billion, $10 billion name. That's more hedge fund stuff.
Stablecoins are the biggest use case in crypto right now, but let's be real. Using them on chain is still way too complex. That's exactly the problem Bridge is solving. Recently acquired by Stripe, yep, that's Stripe, Bridge helps businesses send, store, accept, and launch stablecoins instantly. Explore the future of global financial infrastructure at milkroad.com/bridge.
Haseeb, where are you putting your money right now? And I mean, like, if you were starting from scratch, like you walk into the industry today and I'm like, here's $100 grand invested for me. What would that be?
So
not financial advice, everybody.
I have to let down this question somewhat because I work for a registered investment advisor, which gives me very strict rules on what I can't say. You almost, it was close. Look, what I would say, to give you a very high level answer, is that I don't know that I would change my portfolio very much based on what I would be holding at the beginning of the year or even the middle of the year. I mean, it depends on what you were holding, obviously. If you were holding a bunch of crap or a bunch of speculative, crypto AI mumbo jumbo, then okay, maybe you want to rebalance away from that. But holding the core stuff in crypto, like the stuff that's working, keep holding it. It's not that complicated, right? Like if you looked at the early internet, if I'm right, that this stuff is a big, long-dated macro trend that we're all investing into together, then if you looked at the early internet and you looked at the mid-internet and you looked at the late internet, it wasn't like, oh man, 3 months of volatility, you should change your portfolio. I'm sure there's stuff that you can momentum trade, and I'm sure there's things that go up and down. It's not my business. I don't do that. I'm sure you have other guests who are more built from that kind of, cut from that cloth. That's not me. I'm a long-term investor, and my long-term investment thesis, basically nothing has changed in the last 3 months. And so I don't think fundamentals have warranted any kind of real repositioning. The way that I think about it in crypto is that fundamentals are like this nail that's drawn into the wall. And momentum, sentiment, animal spirits, macro is like this big, long string of a pendulum. And it flies around as the ground is shaking. And the price is that thing on the end of the pendulum. And it's moving around, it's going up and down, it's flying everywhere, and you're just like, oh my God, what should I be doing? And the price is moving here, it's going there. For me, I'm like, look, just look at the nail. Has the nail moved? If the nail hasn't moved, it's fine. Not that much has changed. What exactly has changed in the last 2 months between ETH going to like 4,800 and ETH being at 3,000? The answer is basically nothing. I have not seen a single thing change about this industry in the last couple of months that would warrant some kind of big repositioning. So to the extent that's an answer, that's my answer.
What would warrant a big repositioning?
Something being invalidated. So if you see, for example, that a quantum computer breaks crypto, if you see, for example, that stablecoin supply on Ethereum is plummeting, if you see, for example, that Tether decides that all sorts of things that you could look at this and say, wow, that really changes the fundamentals of what's happening in this industry. Has anything like that happened? Obviously not.
Right. Okay. Great answer. Very, very responsible answer considering the way I worded it. I want to get to a question from our community because we always ask our community for some great questions. We've got a really fantastic in-depth one here from Batchav. So he said, my portfolio is heavily concentrated in Bitcoin and ETH across various investments here in Canada, like TFSAs and RSPs. With DATs further amplifying the skew, the thesis has been that ETH could undergo price discovery and reach new all-time highs of 7,500 or 10,000 in 2026, implying a 2 to 3x return. But given a new point that there's a non-zero chance ETH may not outperform Coinbase, does this undermine the case for holding ETH directly, spot or ETS, as the core allocation? Scenarios I'm weighing, and this is still part of the question. ETH price discovery succeeds. It's a long question. Our man
Bat
is
or an essay. Like what?
Bat is detailed. All right, shout out to Bat. We get some detailed responses.
Thank you, Bat.
It's almost done. Hold on. There's the scenarios I'm weighing. ETH price discovery succeed. ETH hits 75, 10,000. Outsized returns, thesis validated. ETH stalls versus Coinbase. ETH underperforms Coin despite constructive macro, concentration risk exposed, or balanced diversification reduced by ETH and SOL allocations add to Coin or cash flow assets for a smoother risk reward profile. Man, Bat, dude, I feel like Bat should be doing the show and I should be learning from them.
Yeah, clearly. Okay, well, so Bat, you are correct. Those are the potential outcomes. Either this one does better, that one does better, or they both do okay. Yeah, I almost don't have anything to add to your analysis there. Like, yeah, look, I don't know. The answer is obviously I don't know. I think Coinbase is a very different asset at this point than ETH. You can see that is that the two have not, obviously there's correlation between the two because it's from crypto beta, but the two behave very, very differently. Coinbase is a bet that Coinbase will continue to be dominant in the US market. It's a bet that their margins will continue to be able to hold strong for retail, and that they'll be able to scale the institutional side of their business that continues to drive a lot of the, I think, marginal excitement about Coinbase. They make most of their money, like in terms of margin, in terms of profits from retail, but they have an enormous amount of growth and an enormous amount of revenue that they're making from their institutional business. So it's a very different game. Betting on Ethereum, totally different story, has very little to do with whether or not Coinbase can hold on to their margins and so on, or whether they scale their institutional business. Ethereum is more the bet that Ethereum, after the pivot that they've made this year, continues to hold on to the TVL, the activity, the kind of lindiness of Ethereum, that they're able to hold some of the barbarians at the gate with respect to Alt-L1s, with respect to Solana, with respect to BNB chain, and that they'll maintain their dominant position with respect to the financial flows that are running through Ethereum. And then lastly, that they're going to continue scaling the L1. There's been a lot of criticism of Ethereum in years past that they were not really focused on scaling and they were delegating everything to the layer 2s, and that caused a lot of value leakage to the layer 2 ecosystem. I think Ethereum has woken up to that this year with the pivot in the Ethereum Foundation, now moving to leadership under Tomasz and Xiao Wang. That puts them in a position to be able to say, no. We are scaling the L1. Ethereum is here to stay. This is where you should build. I think it was just earlier this week that Vitalik tweeted, you should come build on Ethereum layer 1. Fees are low. Come build. They just increased the gas limit, I think basically 2x it compared to what it was just a year ago. So all that I think bodes well for Ethereum, but will it outperform Coinbase? Who knows?
Excellent answer. Well, Haseeb, I will wrap up there. Thank you, man, for coming back on the show. I'm sure we'll have you back in the new year. Hopefully, no fundamentals or thesis change between now and then, but maybe the price action will a little bit to the upside.
Thanks for having me. Thank you, everybody.
Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.